Today I want to go through some data that 100% proves that both the GameStop and AMC floats have been sold multiple times over. Ortex recently released some very unusual short interest data that ties in heavily to some comments recently made by Virtu on how they are begging not to disclose their short positions. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, Tendy Baron tweeted saying update number 4, Ortex reports another increase, plus 98 million GameStop shares shorted to a live short interest of 152 million shares sold short. The short interest percent of free float has increased by 181.84% today alone, according to Ortex. Now obviously yes, the Ortex data is self-reported, but that also means the self-reported number of shorted shares just tripled in a single day. The GameStop short interest percent of free float just increased from around 20% of the float shorted to a whopping 60% of the float. Now that's very interesting and very unusual considering the GameStop and AMC short interest has remained at around 20% over the last 2 years, ever since these hedge funds and market makers were caught manipulating the stocks. Obviously at one point the short interest was well over 100%. Ever since these hedge funds and market makers were caught, they've been manipulating the data and not telling us the true amount of shorted shares that they're holding. Obviously, we know these hedge funds and market makers have increased the number of synthetic shares or synthetic short positions and have increased their short positions over the last year and a half, but they've never reported it through Ortex, the self-reported platform. Obviously, they're trying to hide their true short positions, but this release of data may suggest they've just messed up, suggesting the short interest tripled overnight. Now as a result, Ortex even went to the extent of creating an account on Superstock, the Reddit group, and they said Ortex responded to the massive increase of reported live short interest on GameStop and wrote the massive spike in short interest is related to an extremely large increase in borrowed shares. So Ortex has even admitted this definitely was not a glitch and there was an extremely large increase in borrowed shares. But obviously Ortex tried to cover their asses by saying it's likely that a huge amount of stock is being borrowed for reasons unrelated to short selling. Now I can't really imagine why over 100 million shares of GameStop has just been borrowed if it's unrelated to short selling. Maybe it's because it's related to synthetic short selling. But it's very interesting to know that where this short interest tripled overnight, this is not a glitch, it is absolutely 100% accurate reported data. These hedge funds have generally reported and generally admitted they've potentially tripled their short position overnight, or they're likely shorting many times the float over. And very interestingly, Tendy Baron tweeted saying the GameStop data anomaly on Ortex today also happened with Tesla on their split back in 2020, and 90 days after that, Tesla started its slow squeeze shortly afterwards. Now I wonder where I've seen this 90-day ruling before. That's it, when a stock is split or a new dividend is issued or a new preference share dividend is issued, like with APE, 90 days later, these shorts and these FTDs need to be closed out. Now whether this 90-day ruling actually applies to APE or whether these hedge funds can somehow skirt around it, it's very interesting that 90 days after a short interest data anomaly on Tesla back in 2020 after their split, it started its slow squeeze. Now Ortex also said that GameStop wasn't the only stock impacted. They said the short interest data was also impacted for AMC, Bed Bath & Beyond, and many of the other meme stocks as well. But interestingly, it seems this giant short interest data anomaly is most likely due to the GameStop split and the AMC APE dividend. As you can see from this chart with Tesla, 90 days after the original Tesla stock split, there was this giant increase in Tesla shares on loan or shorted Tesla shares. And it seems that right now we're basically seeing the exact same thing with GameStop, where 90 days after the GameStop split, we're going to see this massive increase in shorted shares like we've just seen today. And it seems this very interestingly ties into Virtu pooping their pants over reporting proposals. They've said the short sale data bears little resemblance to reporting entities' actual short positions, and also basically said, please God, don't ask to see our buy to cover data or the shares we've shorted through the market maker exemptions. And if you haven't already, be sure to join the free Discord linked in the description below. We've got 1348 indicators and we talk about AMC and share due diligence all day long. And while you're down there, be sure to sign up to Moomoo right now to get 15 free stocks worth up to $2,000 each, a whopping total of up to $30,000, and a guaranteed $10 free on top of that. The SEC obviously proposed this new regulation to increase the amount of data reported around short sale positions. Virtu commented saying the stickier shock of the estimated costs is all the more unreasonable given that much of the data the proposal would seek, such as buy to cover and bona fide market maker exemption markings, constitutes nice to have information. It seems this recent SEC proposal around short interest data or shorted shares not only forces these funds to disclose their short positions, but also forces them to release data on their buys to cover and the bona fide market maker exemption markings. This would obviously likely expose that many of these market makers like Virtu and Citadel, while they've legally shorted 100 million shares, they've illegally shorted through their market maker exemption billions of shares. But Virtu also said the cost to implement the proposal dramatically outweighs the potential benefits of collecting short sale data, especially because that data would bear little resemblance to reporting entities' actual short positions. Likely because obviously the data they'd have to disclose legally, such as disclosing their legal short positions, bears no resemblance to their true short positions when you factor in all of these synthetic shares and these swaps that are hidden. Right now, Virtu seem very panicked about disclosing their true short positions and about disclosing their market maker exemption markings. And that is likely why the short interest data for GameStop basically tripled overnight. As a side note, it's also crazy to see the GameStop short interest back around 60%, considering it's held around 60% for the last year and a half. It seems almost unusual and crazy the numbers are getting this big again. I think that's likely because many of these hedge funds and market makers have genuinely doubled down on their short positions once again. We know these hedge funds are running out of available collateral and struggling to meet these margin requirements, and therefore it's likely they're going for one last final Hail Mary attempt to try and bankrupt AMC and GameStop. But I don't think that's going to work. Copy-paste tweeted saying that Amazon just lost $250 to $275 billion in market cap in only 10 minutes. He said that was being used as collateral to meet margin requirements, and he said that tomorrow, aka today, might be interesting. Now I do think it's very important to remember that when a hedge fund or a market maker fails a margin call, they do actually get 14 separate days to meet the requirements of that margin call. Therefore, if any hedge funds were liquidated today or over the last week as a result of the Microsoft, Google and Facebook and Amazon poor earnings results, and as a result of these giant 10 to 20% drops in these companies, it's still going to take 2 to 3 weeks until we actually see the liquidations. Obviously, with 4 of the largest companies in the entire stock market taking on 10 to 20% losses in a single day, I do think that is going to blow up some hedge funds. As copy-paste said, Amazon alone just lost $250 to $275 billion in market cap yesterday alone. And then when I think you factor in the hundreds of billions of dollars lost by Microsoft and the hundreds of billions by Google and the hundreds of billions by Facebook, I struggle to see how some hedge funds specifically will survive. And finally, as Will Clement tweeted, he said, "I wish the SEC would protect us against these mega cap tech stocks. These assets are far too volatile to be accessible for non-sophisticated investors. Why aren't you protecting us, Gary Gensler?" It's crazy to see how the SEC has banged on about meme stocks being crazily volatile over the last year and a half, 2 years, when it's actually some of the largest tech stocks that are even more volatile than AMC and GameStop. Really, the SEC shouldn't be attempting to protect us from meme stocks, they should be attempting to protect us from these mega cap tech stocks, and obviously from these illegally operating hedge funds. And it seems Fidelity are desperate to try and add salt to the wound and try and force us to sell our AMC and GameStop by coming up with a nasty joke. Fidelity tweeted this Halloween costume of a meme stock guy. Fidelity is depicting that all meme stock investors are sad gamers, sad overweight gamers that potentially live in their mum's basement, holding popcorn and DRS shares. Now obviously you know that basically none of us are sad overweight gamers living in our mum's basement. We're very respectable people, and actually this time we are right. Boki tweeted saying, "Really, Fidelity? How completely unnecessary and distasteful and extremely unprofessional. People use you to invest their hard-earned money, and you single out people that like to invest in what you would call meme stocks, and you poo all over your own customers." Again, I think this really shows that Fidelity aren't for us retail investors, and that Fidelity does not support us and likely supports the shorts. And therefore, if you haven't already moved out of Fidelity, I do suggest that you sign up to Moomoo using the link in the description below. Moomoo definitely does support the retail investor and would never do something so distasteful. I think overall it's got to the point now where it's just a bit embarrassing for Fidelity, for the mainstream media, and for these major hedge funds to continuously try to bash retail investors. I think it's got to the point where we're obviously not falling for their games, we're obviously not selling our AMC, Ape and GameStop shares, and they know they're completely out of luck, and I don't know why they still try to push this FUD. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers!